let's talk about one of the absolute best tax benefits in real estate investing: depreciation. It's this awesome paper loss that can seriously lower your tax bill every single year. But you knew there had to be a catch, right? Well, there is, and it's called depreciation recapture. So let's pull back the curtain and break down exactly how this whole thing works. Here's our game plan. We're gonna start with the why this tax even exists. Then we'll see how it changes your property's value in the eyes of the IRS. After that, we'll pinpoint the exact moment it gets triggered, crunch the numbers, and this is the best part, we'll look at the pro strategies for dealing with it. So, first things first, why did the government create this rule? You might think it's a penalty, but it's really not. It's actually the logical flip side of a huge incentive that's designed to get people investing in real estate and providing housing. Okay, so what is depreciation? At its heart, it's a deduction you get for the wear and tear on your building. The government basically says, hey, we know your building isn't new forever, so we'll let you write off its cost over a couple of decades. And that creates a really nice tax break for you, year after year. Now, this is where it gets really interesting. On paper, for tax purposes, you're claiming your property is losing value. But in the real world, that same building is very likely going up in value. You see the conflict? Depreciation recapture is the mechanism that steps in at the end to sort of, well, to square that circle. It reconciles the tax breaks you got with the actual money you made. So what happens every time you claim that depreciation deduction? It's not free money. Every single dollar you deduct reduces your property's cost basis, and this new number, the adjusted cost basis, becomes the starting point for all your future tax math. It's super important. Let's walk through a quick example to make this crystal clear. It all starts, of course, with what you paid for the building. So, for our example, let's just say the purchase price was $300,000. Simple enough? Now, over the years, you've been a savvy investor, and you've been taking those depreciation deductions on your tax returns. And let's say, in total, you've claimed $100,000 in depreciation. You see where this is going, right? That $100,000 deduction directly lowers your original cost basis. And boom, there it is. For tax purposes, your property's basis is no longer $300,000. It's now $200,000. This is the number the IRS cares about when you go to sell. Forget the original price for a moment. This is the new baseline. Okay, so you've got this lower adjusted basis. Now for the main event. What's the specific action that actually pulls the trigger and makes this tax a real thing you have to pay? This is probably the most critical question every single investor needs to know. When does this thing on paper turn into actual cash you owe the government? And you know what? The answer is way simpler than most people think. It has nothing to do with selling for more than you originally paid. The trigger is selling for any amount higher than your new adjusted cost basis. Yeah, this is a hard and fast rule. According to the experts, it is non-negotiable. And this leads to a wild situation that catches a lot of people by surprise. You could actually sell your property for less than what you bought it for, and if that price is still above your adjusted basis, guess what? You still owe recapture taxes. All right, we know what triggers it. So how do you actually calculate it? Well, your total profit from the sale doesn't just get taxed at one flat rate. The IRS actually splits it into two different buckets, and each one gets its own tax rate. This chart shows it perfectly. So let's stick with our example. Our property with a $200,000 adjusted basis sells for $400,000. That's a $200,000 total gain. The first $100,000 of that gain, which is the exact amount of depreciation we took, gets recaptured and taxed at a special rate, up to 25%. The rest of the profit, that second $100,000, is treated like a normal capital gain, which usually has a much lower tax rate. So, with this tax hanging over your head, is it just unavoidable? Not at all. In fact, the tax code itself gives you a playbook with two major strategies for smart long-term investors to either push this tax way down the road or get rid of it entirely. The two big plays are the 1031 exchange, where you basically roll your profits and that tax liability into a new property, kicking the can down the road. And the second one is inheritance, which can be a path to wiping the slate clean for the next generation. And the stepped-up basis is just a massively powerful tool for building wealth. When someone inherits a property, the tax code essentially hits a giant reset button. The cost basis gets stepped up to whatever the property is worth on the day they inherit it. And just like that, all the capital gains and all the depreciation recapture that built up over the original owner's life, it all just vanishes. Which kind of brings us to a final big picture thought. Is depreciation recapture really just a tax bill coming due? Or is the whole system with these powerful escape routes like the 1031 and the stepped-up basis actually designed to encourage investors to do more than just flip properties? Maybe it's a tool to get people to buy, to hold for the long haul, and to build generational wealth. It's definitely something to think about.